Good morning. We will pay attention to the theory of financial statements today. What is the purpose of the income statement? We use the income statement to subtract the expenses from the income to calculate the profit for the year. What is included in the income statement? At the top part of the income statement, we will do the trading account section, where we will subtract the cost of sales from the sales to calculate the gross profit. We use the gross profit plus other income, for example, discount received, commission received, rent received, to calculate the gross income. Expenses is deducted from the gross income to calculate the operating profit. The operating profit is the profit that was made from operations of the company. This is calculated before interest was taken into account. If I use the operating profit and I add interest income to the profit, it will give me the profit before I deduct the interest expense. After the interest expense was deducted, we will calculate the net profit for the year. The purpose of the financial statements is, first of all, in the income statement to calculate the profit for the year, and in the balance sheet to determine the financial position of the business on a specific date. All the balances of your assets, liabilities, and equity on the last day of the financial year will be recorded in the balance sheet to indicate that assets equals equity plus liabilities. In the balance sheet, we will first of all have assets, and we will divide the assets between non-current assets and current assets. Non-current assets are assets that will remain the same for more than 12 months in the future. They consist of fixed assets, land and buildings, vehicles, machinery, equipment. Current assets are assets that will change on a regular basis. For example, the cash that you have, money in the bank, petty cash, cash in the cash float to give change to customers, debtors, the amounts that other people owe you because you sold to them on credit, inventory. Equity at the end of the year will include the capital balance at the end of the year after any additional capital contributions were taken into account. Then we will add the profit that we calculated in the income statement because the owner is entitled to the profit, and we will subtract the drawings to indicate that he's already taken some of the profit during the year, and after we calculated the closing balance of the capital account, we will record it in the balance sheet. Liabilities are also divided between non-current liabilities and current liabilities. Non-current liabilities will remain the same for 12 months in the future. That is, for instance, a loan that you obtain to buy a car, or a mortgage loan to buy property. Current liabilities is money that will be paid back within the next 12 months. So that is the creditors, if you owe them money because you bought goods on credit, or if there's a bank overdraft, it will be recorded as current liabilities. Why is the profit transferred to the capital account? The purpose of the business is to make a profit. The owner gave the capital to the business, so he's entitled to this profit as a reward for the investment that he made in the business. Why will drawings be transferred to the capital account? After the profit was transferred to the capital account, the amount owed to the owner is determined. That means his capital contribution plus the profit that he's entitled to. The drawings is deducted to determine what is his total interest in the business after the profit was added and the amount that he's taken during the year was deducted. He already benefited from his capital contribution during the year because he took either money, goods, or assets from the business for his own use. What is included in the capital account? The capital contributed by the owner plus the profit for the year, less the drawings.